Hi, everyone. I'm Rick Bensignor. Today is Tuesday, July 14th, and welcome to this week's In the Know Trader Show. As we record late Tuesday morning, the S&P has traveled quite a bit this morning. It is now currently up 8 points, but the low of the day is all the way down at 31.28. It is now 31.64, so a massive bounce. And basically, it is very close to the highs of the days of 31.67. So we'll talk about that a bit later, not only when we talk about the S&P itself, but also has to do with our trader education portion for today. Bonds are down about 3 ticks. The 10-year at 61 basis points. Crude oil is up about 40 cents or so, and gold is pretty flat on the day. So let's talk about what we're going to do today. We will do our markets overview as we do each week. In our trader education session today, it'll be short but very to the point. I've entitled it "Business Media Needs Answers to Sell Something." And then today I figured, especially given what happened in the market yesterday, where the S&P essentially touched by just a hair a new high for the whole rebound off of the March low before falling apart, let's take a look at some of the most popularly held names. So we'll certainly do what I call the Mafang names, but also we'll add on to that as long as we have time, and I will do my best to get to everything today. We'll also add, besides those Fangy type names, Exxon, Cisco, J&J, Disney, IBM, Verizon, and Procter & Gamble, because these are very, very popularly owned names. So what I guess we call in the industry is widely held, and we'll take a look at those. Couple of things here, just as I give you contact information for me. Rick at inthenowtrader.com is the best way to email me. Of course, our website is inthenowtrader.com. And I want to alert you to the fact that on August 1st, I am starting a new monthly sector report. I'm having a disastrous technology couple of days at home, so I've not been able to update my website. Every time I do it, it falls apart as if I've done nothing. So within hopefully the next 24 to 48 hours, it will all be updated with the information about this new report. But it is going to launch August 1st, and it's called 711. It is a SPDR macro ETF sector report, and the goal of the report will be to beat the S&P by being in no more than 7 of the 11 sector SPDRs out there, with the goal of eliminating those that are underperforming. And obviously, if you're in the bulk of those that are outperforming and you stay away from those that are underperforming, you're going to do better than the S&P. So I will use all the institutional models I have at hand, along with 40 years of experience in the markets, to do that. And again, that launches. So take a look at inthenowtrader.com. Just give me a day or so, and hopefully I can get that website updated. Let's take a look at sector versus, the 11 sectors, how they are this week, year to date, versus how they were last week. Each week we try to take a look at this to see which sectors are really moving. I judge a sector move in relative terms that moves me on 1% from the prior week as being significant. If it increased by more than 1% versus the S&P, it gets a green dot. If it decreases by more than 1% versus the S&P, it gets a red dot. So you can see that this week, 4 sectors have outperformed the S&P by more than 1%. That's commercial services, healthcare, utilities, and financials. So despite the fact that financials are the second worst performer year to date, they did pick up over 1% versus the S&P from last week. So that's why it's there. And of course, the negatives here are industrials, energy, and real estate having a particularly bad week relative to last week also. So that's that. Let's take a look at the charts. So here's the S&P. You've seen this chart before. And in fact, just earlier today on StockCharts.com was my second half of the year outlook. That played at 10 a.m. Eastern time. And don't know if they will repeat that. I hope so, but try to catch up on that too, as it'll talk about what I'm expecting across a variety of global markets for the second half of the year. This morning, we'll take a look at the S&P. So here's to me, kind of the essential elements of what's going on in the market now. First off, obviously, this is a weekly chart. So yesterday was Monday. We gapped up as we opened strong from just weekend news and not enough negativity to push the market down. Touched and actually exceeded the June high by 1 or 2 S&P points. But then, of course, we had that big afternoon sell-off yesterday as California announced that they'd be reclosing many businesses and that public schools in the LA and San Diego school districts, which are massive public school districts, will not start off this coming fall with in-person classes, and the market sold off. And so here we are in real time with the S&P kind of about 3163. I put this as being hugely important because it is the downtrend line from the all-time highs against the June high. So now we have a potential double top. Now, obviously, there's strong support down here near 3,000 with multiple weekly lows. And in fact, if I put up the Ichimoku chart, you will see that on the weekly chart, this first line of support, which is the pink line known in English as the conversion line, was exactly where the market bottomed in the last month on multiple weeks. So now you kind of have a push and pull versus where we're trading now. 31, I think it's 31.83 is the value of this trend line for this week. So I'd pay attention on Friday to see whether or not we close above or beneath that trend line on how much. If it's 2 S&P points, it's meaningless, and that's not going to do anything to me. But if we have a significant decline and we're well beneath 30 holding, would now know that if you get above this week's high or 9, now they have a negative bias. Otherwise, we see a possibility that we get down to 29.34 or 29.35, something like that, the bearish propulsion level. That if come to it and it's disqualified by having the prior week before we get down there having been a down close relative to the prior week, then it's disqualified. That becomes a buy area, and anywhere from 29.35 to 28. These up lines, well, this down line, there's a lot you can see in this kind of expanding pattern that, to me, the midpoint was the fall from all-time highs to the March lows. So there was a minus 34 degree angle coming off of the high that nailed the June high, or it didn't nail it, it created the trend line for this downtrend line. So line X here is a 34 degree line off the low. That would be symmetry. So if we were to sell down and eventually hit this line, you'd have still the symmetry of the market. So, but what I also did was add a 1.5 times value to this line. So if this was a 34 degree line, I made this 51 degrees, and I did a 2x line at 68 degrees. And the reason I did that is I think there's a natural sway in this market, because let's just call it a bullish skew because of the Fed and what I now call the Powell put. Used to be the Bernanke put of years ago. I don't really remember hearing the Yellen put per se, but I call this the Powell put because we know the Fed chair has told us that he's going to do everything possible when needed to keep the economy going and provide liquidity to the markets. So my guess is we do not get down to this X trend line, but that ultimately the lows as the year continues on will touch the 2X line or the 1.5 X line. So that's what I'm looking at too. That's that in the S&P. I think the monthly chart of Gold is significant because we actually have a more calm. And when I look back at some of the ones in the past, this album on 6 months long was a high for over a year. So this is potentially significant because this the levels here are still kind of up against in the neighborhood of prior resistance. The highest of the monthly highs after all-time highs was made was 1804. So August gold is trading 1813 right now, but October really is going to be the front month very shortly, and that is, well, that's actually trading a little higher than there. Nonetheless, we're still in an area that putting on new long exposure in gold is tricky. I actually rather do it in silver. Silver's close to a breakout, whereas gold broke out a year ago. Silver is breaking out now. So that if I'm going to go on precious metals, I'd want to be in silver as compared to gold. Not much to talk about in the bonds. The dollar, I think the dollar is still in the process of weakening. So now let's get to our popularly held names. And what we're going to start off with is just the XLK, because that represents, that's the SPDR ETF for the technology sector. And of course, so many of these widely held names are big cap tech names. So I figured let's take a look at that. And what we see is that the general trend is obviously up. The angle of ascent most recently is even stronger than prior angles of ascent. So I don't know if I'd call this parabolic quite, but it's certainly a vicious straight move up off of the March lows. We do have some suggestions here of upside exhaustion. And even though they came in a month ago and we've gone higher than there, the stop out level was not properly exceeded. And therefore, it's still an active level. So just north of 107 is still kind of where you're not stopped out of the idea that you're in a danger zone to be putting on additional longs. And you can see that this upside exhaustion 13 signal here came a couple weeks before a decent fall in percentage terms. In the past, it did it here back in 2018 too. So I'm not at least chasing after these names up here. I'm not looking to buy Apple this high up, Amazon, any of them. I'd rather buy in a pullback. They're still great names, but not here, not now. So let's take a look also at the XLK divided by the SPDRs. All right, so here's relative performance. And we have had technology issues all day, so we'll see. Yep, at least we got an updated chart. I'm going to switch this to a monthly chart. So here's long-term history. You go back to 2000, here's the peak in technology over the S&P. Then, of course, it got crushed for a couple of years. 13 right near the low, 9 on the secondary bottom, 9 here in 2013. We've got a couple of upside exhaustion signals that were in the midst of counts. So this one you wouldn't have taken, and here you're up to a 9 count, which says you're still there's still strength here in this sector. I just feel like I don't want to keep chasing technology at this point. Let's look at some of these key names now that are held. So we're going to try to get through these all. We've got about 15 minutes left. We've got, I don't know, probably close to 15 names. So that's good. We'll do a minute or so a name. Let's start off with Microsoft. And we will look at all these on a weekly chart. Because I feel like that gives you a pretty good perspective of the medium to long term. Notice just on the way up how often the conversion or the baselines, that's the pink or the orange lines from the cloud charts, held as support. When those give way, it often means you're going to get down to the cloud. And notice the low in early to or late, the Christmas low in 2018, top of the weekly cloud. Earlier this year on the March decline, where was the low? Top of the weekly cloud. So this is where those who use this model will do their most significant buying in a bullish market. And you can see that has worked nicely. Even if you go back to 2016, you can see the cloud here. We got to the bottom of a very narrow cloud, but that was the low of the move. So Microsoft at 206 and change, to me, at a minimum, I'd wait for a pullback to 196-ish or so. Next week, that'll be a little higher. But I would again, not chase here. Also, given the somewhat exhaustive look to what we're doing the last, 2 weeks. So it depends on where we close out this week, but still be like the name, buyer in a pullback. Don't want to chase after it here. Let's take a look at Apple. For those who know the cloud chart, back here in 2018, price broke beneath the cloud. The lagging line did not. So this never went into bearish mode. It actually got a 9 1 week before its lowest low. With a lagging line in the cloud, that is a aggressive buy signal for those who are aggressive traders. Upside exhaustion here before the March sell-off comes all the way back. Same type of thing now. We made an all-time high this week. We've pulled back, same type thing. On the whole way up, it's been so strong, we haven't even once touched the conversion line. So I probably, again, wait. If you like the name and you still want to add, you wait for a pullback. Let me put propulsion on here. So look where the high is. The all-time high was targeted off of the low in March. So 1 week after the low in March, this model that we use in the No Trader all the time suggested that if we broke above 259, we would get to 305.5, and if it broke through 305.5, it would get to 398, and that is exactly where the high is. So I am definitely not chasing after these names here, and we'll wait for a pullback before I come back in. Minimum downside here is 371, better at 342-ish if you get the chance. Facebook. Made an all-time high this week. Choppier of a trend, you can see, but still long-term uptrend intact, higher lows, higher highs. Hit propulsion level back about 5 weeks ago or so at 238. You're kind of right there now anyway. So given the new high and the pullback, I'd still wait. Again, if you're going to come after this name and you think that it's still worth putting new cash in, I'd probably wait for the mid to upper 220s at a minimum before I come back in. You should be able to get that chance to get it there. Otherwise, it's also not the craziest thing to take some off the table, given this run. And as long as you can deal with the, I'm not talking as far as tax terms and whether or not these are long-term holds or shorter-term holds, but not the craziest thing to also lighten some here. Amazon. New all-time high this week, one of the stronger stocks. Notice how the cloud held all the lows and where it needed to before it ripped to the upside. I don't even have a propulsion signal, anything close. Great name. Obviously, it's just a matter of, if you were going to put new exposure on, do you want to pay over 3,000 for it or not? I'd rather use at least first place that I would consider buying is against the conversion line here from the cloud chart. There's a weekly cloud, so 2837 for this week. And otherwise, again, not chasing. And it's going to be similar for most of these fangy names because they've moved up so much. Netflix. So Netflix had a upside exhaustion signal. Let's see, this is 2 weeks ago. So at that point, you're not buying. It's too late to put cash in, even though it doesn't mean it can't go higher, but it means the risk is significant. Given what it's doing now, and it's actually beneath its propulsion bearish level, I'd say if I was going to do any buying, it'd be not until about 480 or something like that. See if there's anything else here that really kind of stands out. I don't actually, in just a simple look like this, not really. We're kind of, MACD is getting towards, the highest highs it had here over the last few years. It's clearly overbought, but that doesn't stop tech names. And Netflix obviously has gotten tremendous interest as we work from home and people are home so much more and kids are home, etc. So if I'm going to do buying, I wait for a pullback. Actually, let me just take a look at monthly. No, nothing different there. Okay. Google. All right, here's a weekly chart. We hit propulsion exhaustion, and you can see we've come off of it. Support's going to be somewhere, initial support's going to be somewhere in that mid 1450s area, about another $50 lower. You can see both the conversion line and the propulsion level are down there. So that'd be an area that, again, if I want to chase after this, I wouldn't do it until we pulled back there. MACD well off the highs of where we had earlier this year, even though we made a higher high. So potential negative divergence there. And I kind of pay attention to where these old highs were at 1530 or so and where we close out this week. Because if you close underneath there, then you still may see some further selling coming in. So at this point, also not a crazy idea to take some profits. And it doesn't mean you can't get back in. But given the run this has had and the possible double top in the S&P and the possible, failure here, not the greatest thing to take some off the table if you're long. All right, now let's look at some non-technology names, but just those that are widely held. So I took a look at a list of like the 25 most widely held names in 2020. So I've got about another, 6 or 7 here to go to. And thankfully, they're not in the tech space because they should have different looks. So we're going to start with Exxon. And obviously, this chart's going to have a very different look. This has been let's bring in some more data. This topped back in 2014. And obviously, what happened over time in the oil market and the declines that we've seen, this has become a very heavy chart. I'm trying to remember where I got out myself. I had held this name for years, and maybe it was a monthly. I don't know, or maybe I sold this 9 a year ago. Well, I remember I got out in the 70s, and I think it was just kind of seeing that we had 9 and 13 bottom into another 9 bottom, 9 up, 9 down, 9 up. 9 a couple of weeks before the bottom, and I think I just kind of got rid of it because I was not bearish. I mean, it was not bullish oil at all. I think I kind of got rid of it off of here. Nonetheless, what we've got now, very heavy chart. Let's see, other than the recent lows. So the lows we made here down to $30 or so is the same low we got back in 2002. So if you look at how many institutions, when you think about it, own this name, again, it's very widely held, as it is by the public. Sure, it can rally. If it ever got back into the mid 60s, I'd probably let it go because you're going to have. Look, let's take. There's 2 lows in here. The low here in 08, the low here in 10. We broke through. We came almost back to it. So even if you get through, you've got lots of shelves here of prior bottoms. So anywhere from the upper 50s to the upper 60s is going to be or should be massive resistance. And, it's just not a name I have in my portfolio now. And from a trading perspective, last week we got to the propulsion level that would kick in bearishly if we properly exceeded it. We didn't, so you're getting a bounce. Look for resistance now initially at around 49 and a quarter, give or take, and then more so north of 57. And that's, the zone between these 2 purple lines. So for bottom fishing, if we got down into the mid 20s, maybe I would take a chance there. I mean, after all, this is Exxon. But for longer term holders, this is the type thing that if you get the opportunity ever to be between the upper 50s and upper 60s, my suggestion is you unload the name. Here's CSCO, if I can type the ticker correctly. Here we go. So this has a long-term breakdown in structure using the Ichimoku model. We've broken beneath the cloud. The lagging line is beneath the cloud. You can see we topped on a setup 9 count. That's 9 consecutive Fridays that the close was above the close from 4 Fridays back. That called the top here. not so far away from where it did here too. It did exceed it, but this 13 never got stopped out, even though we traded above the level because of how it traded above it. So that is still an active line. So I'd say this is probably somewhat dead money. And I'd say anywhere from upper 40s to low 50s is probably decent resistance. So not a big fan of the name. Johnson & Johnson. Total sideways market. I don't need many models here or anything to see that, right? So let's take Ichimoku away because it's not going to be helpful in a chart like this. So for years, this has really gone nowhere. 13 and 9 exhaustion signals coming darn close to the top. The stop out on the 13 is this line here at 154.30. You had one Friday close above it, but it followed an up Friday close. That doesn't stop you out. So you're still in this zone all the way from late 2019 that says there's upside exhaustion. So, you know, this is a name that could easily come back towards the lower part of its range. Let's go back here to mid-2017. So you can see multiple lows, and we've had, let's just call it, you know, kind of highs in and above that area. So I kind of consider this fairly dead money. Now, if we were to break out cleanly above 154, then it has room to go. But otherwise, it's not a name I feel like I've got to be in. Disney, which announced that they've opened up again in Florida, which kind of amazes me, but they have. So look, 13 plays with its stop out level, never gets stopped out. Sell off into the March low, 9 high since then. We come to the propulsion level, don't properly close beneath it. So that's still an active level. So as long as we're above 109, this is okay. And resistance, I'd say up near 132. And for now, until the, you know, people actually go back in numbers, which seem hard to think about right now, no real big reason to own it. Let's see, downtrend, we're still beneath the downtrend line. So I'd say if you got some pop up into the this area here, 132 to 136, so let's just say the low to mid 130s, I'd probably get rid of it and only put it up back on above 152. And if things really got nasty, I don't think they will. This thing goes back to about 90. IBM. So this is a name that's been distributing for a while. Maybe, you know, I don't know if it's a perfect channel, but just eyeballing this, looks like we've got some type of, here we go, let's go even back there. I don't know, something like this. So we didn't quite hit the bottom of the channel, but you've got this long-term downtrend going on for years. This is old technology, obviously, and it's just, you know, they play in the cloud, but not anything compared to the major players there. I don't see much at all here. I'd be a seller on rallies if I had it. And lastly, Procter & Gamble, 13 high, back on the highs. And here, let's spread this out so you can see the March sell-off. I mean, this is held in pretty well for a consumer staple name to be this close to this year's high is not bad. And of course, that is the all-time high. So kind of would surprise you how well this name's doing. But then again, with everybody at home, you need soap, diapers, and that type of stuff. So I'd say in general, it's above 117. It still looks good. That's it for this week. This is Rick Bensignor and In the Know Trader. Thanks for listening.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.